Welcome to our webinar, Build Back Better Tax Act, Estate and Trust, proposal by Ways and Means Committee as of September 21st, 2021, presented by Chuck Thornton. If you would like to collaborate on a webinar at no cost for your colleagues or with your trade association, please call our office for details at 602-678-7067 or send an email to info@rcthornton.com. We would love to work with you on your business topic of interest. It is my pleasure to introduce you to our speaker, Chuck Thornton of R.C. Thornton and Associates. He is an author, lecturer, and graduate of New York University with a master's in taxation. His firm's mission is to help clients achieve financial success. That means saving on taxes too. Welcome, Chuck Thornton.
Oh, thank you, Kit. Thanks for the introduction. And thank you for listening to our webinar on the Build Back Better Tax Act, Estates and Trust. You know, it's not even certain whether that's even what the title of it is, because people keep on calling this all sorts of different things. But this is part of that $3.5 trillion budget that they're proposing right now that is laden with taxes. So let me just do a few administration things here first. First of all, it's for general information. And the thing I want to comment on this is that this isn't passed yet. It may not get passed. It may not get passed the way I'm presenting it. But this thing is chock full of so many things that you need to get thinking about as to whether you want to take moves before certain magic dates. Now, we're going to be presenting the topics in different webinars because this is so voluminous. It's 811 pages. We're talking first about estate and trust. We'll be talking about business taxes, individual taxes, retirement plans, tax credit. The presentation is not necessarily in the order of importance. We just put the emphasis first on the things that have more implementation dates to be considered more in the near future versus maybe after the end of the year. Now, we're going to talk about the estate. Let's talk about just in general. Should you even be listening to this? If you have an estate greater than $5 million, I say yes, you should. If you have the aspirations that you're going to have an estate more than $5 million next 10, 15 years, I would think this is for you also. If you're married, then it's $10 million. I'm giving you round numbers. I'm not giving you precise numbers. So if your net estate value is a couple $1 million, you have no trust, nothing else in there, you're single, you're married, maybe there's nothing in here to be concerned about. But again, if that 5 million individual, 10 million married, or aspirations that you're going to be over those numbers sometime in the next 15 to 20 years, this is something that you probably want to take a look at. Now, there is a little bit of a technical how these laws get passed, which you need to know, and I would be repeating this part of this presentation on each one of our programs. So the question of it is how does this law go, and what is the impact of implementation dates? That's the piece that I'm trying to get to. So basically, things usually start at the House Ways and Means Committee. This is a subcommittee of the House Representatives. Their big things talking about budget, dollar amounts, and so on. And there are a certain percentage of Republicans, certain percentage of Democrats. Typically does not get out to a vote unless majority of the people in that chamber vote for it. Of course, obviously it's majority Democrats, so it's pretty safe to say that this stuff will move up to at least certain points. So eventually, as the House Ways and Means Committee, the Senate has their own Ways and Means Committee. They kind of work the same way, except the number of Republicans and senators are an equal match, and we'll talk about how this filibuster rule works. Eventually, it goes to, after they hash it back and forth, it goes to a Joint Ways and Means Committee. The idea here is that they can't have all these hundreds of representatives and senators arguing this thing back and forth. They have to kind of contain their arguments in these different areas. Joint Ways and Means Committee is where it might be modified. It may not be modified. Still not law yet, okay? Then it goes to the House, it goes to the Senate, And you'll notice I'm going to skip down budget reconciliation. Budget reconciliation is if they can do this law change that will fit the budget within a certain specified amount of time. By the way, this is how the Trump got their law through before, was using budget reconciliation. And that's why in budget reconciliation rules, what happens is certain things will expire and revert back to the way it was as of the date that they did this. And so therefore, even under Trump's bills, there are certain things that are going to lapse in 2026 anyhow. And so to go for just a simple majority, they have to use the budget reconciliation fast track. It's the anti-filibuster rule is what happens. Regardless of that, if it passes, then it goes to the president who signs it, and that's the enactment date. So you have different dates, and let's kind of talk about one is the date it was submitted for consideration. That date is September 13th, and I'll point that out to you. Well, I can tell you the one that I can tell you right off the bat is capital gains. Transactions September 13th and afterwards would be subject to a different capital gains if this passes. Another one is enactment date. Enactment date could be, who knows? It could be October 28th. It could be November 3rd. Is whenever this thing works its way through the Congress and Biden would sign it. So therefore, there are certain things that you could do between now and the enactment date that could make a difference in taxes. And this is really what the theme of this presentation is there's certain things that you can do between now and the enactment date, and who knows how long that's going to be. I wouldn't suggest it's going to be more than a couple of weeks, maybe a month out there. And then the question of it is, do you even think these changes are going to pass, and what kind of time frame? There's other implementation dates are after the end of the year. So if you think through timelines, if some of this stuff motivates you as I'm talking about this, you may need to move quickly to get things in place, and then you're betting on whether the thing's going to pass anyhow. So you can have buyer's remorse if you do a lot of things that you wouldn't have done otherwise, and it turns out this thing doesn't go through or it doesn't go through as it's scheduled. That's just, unfortunately, that's the nature of what we're faced with right now. Okay, so timeframes to summarize, some are retroactive, like the major one has to do with capital gains. There's some other ones that go back 2 years, but they had to do with procedural process and so on. Some are the dates I proposed, as I mentioned. Some are upon enactment. Biden puts the ink pen to this whole thing and signs it. Some are next year, and some can even further out. The dates are important. Keep them in mind, and there's no guarantees on this. So anything that you might want to do is a function of what was your inspiration point of what you're willing to do to begin with. And I'll give you some suggestions. Okay, estate changes. Unified credits, some of you probably know that you can make gifts or you could pass away and leave things to any beneficiary, excluding your wife, because you get an exemption 100% for the spouse. You can leave it to them and you would basically get an exemption. I'm going to talk somewhat around dollars. You'll see me get to the precise ones in a moment. But this act terminates a temporary increase in credit passed under the Trump regime because they did it on the budget reconciliation for Trump. So Trump's tax changes, which is part of the Republican reconciliation, are temporary and were expected to expire in 2026 anyhow. What Biden does is he basically, when I say Biden, this is a Biden tax thing, but it's really the Democrats, I guess I would say. He resets the exemption back to the 2010 number, which was $5 million, which means in 2022, the exemption will be $6 million, whereas it was under the Trump regime approximately $11,700,000. So what's that mean? It means that there is an opportunity to do some chunk of gifting before and transfers before this thing is enacted. Okay, is what would happen. When I'm saying enacted, I'm sorry, not enacted before the end of the year, but there's certain things you have to do to make all this work before enactment date anyhow, like trust and things like that. So I'm going to slip sometimes. I'm going to say that you probably only have up until the date of the signature, although technically you still can make gifts before that point. If you're under these $6 million numbers, then perhaps you may or may not be inspired But if you're one of those people who anticipate your estate's going to be larger, there might be some room for gifting. There is just no hard set rule. I'm going to give this some hard think. Okay, now here is the real numbers. I've been using round numbers. The old exemption before the Trump came in was 5,850,000. Trump doubled it, see it right there, and the exemption became $11,700. Effective January 22nd, if this thing passes, or 2022, it will be $6 million, which is the old exemption, which was 5,850 adjusted for the inflation number. Okay, I'm going to use an example. I could come up with tons of examples on this thing. And by the way, you can get a copy of these slides if you want to look at this example again. Kit will tell you how to do that. So I'm going to make a comment that no one used grantor trust or discounts in this, because that's another aspect. I just want to focus on this credit is what I'm trying to do. They use Mrs. Jones, single, $700,000 of her estate and gift exemption prior to this gifting, and therefore she has 11 million exemption remaining. That was the 11.7 from the prior page minus the 700 that she's used. She has a $21 million estate, and if she makes an $11 million gift, this will reduce her estate to $10 million. Okay. If Mrs. Jones dies 2022, she would have no exemption remaining, and the estate tax would be $10,000 times the 40%, $4,000. Now, by the way, one proposal had been the tax rate could go up to 65. That did not happen. It stayed at the 40%. If Mrs. Jones makes a gift and dies 2020, she'll only have the 5,300 exemption remaining. That's a 6 million minus a 7. That's the prior gifts, resulting in a taxable estate that would cost her $6,280,000 in taxes. So here's your difference. She makes her maximum gifts now, and she dies next year, $4 million. She doesn't do it, it's $6,280,000. Now, I'm using the extreme numbers. Some of you may be saying, oh, well, my state's not that size. This doesn't apply to me. No, there's other variations of this. Maybe you use some of your exemption. Maybe you can't do it all. Or maybe you have a smaller estate and you believe that your estate's going to grow. You're in your 30s, you're in your 40s, and you think it's going to grow. What you're looking at is what the estate is going to look like at your death. And that is where you will have less of an exemption as it is right now. So you need to have a discussion with us if we're your CPA or whoever your CPA might be. You need to have a discussion to rule this in or out. Okay, now, if Mrs. Jones did not make a gift, but is on her deathbed for December 31st, hoping for a miraculous recovery and a few more years in the very nice retirement home she lives, would you want her children or best friend to make her healthcare decisions at that time? Because you can see one day in her life could cost $2,250,000. So it's a little bit of humor. Maybe you don't want to have family members making those decisions. Okay, another factor to consider is use the temporary exemption gifts must exceed what's reduced. Now, this is the point I want to make, and I won't go through this whole slide. In order to get a benefit, you have to exhaust the existing exemption that Trump had, which was 5,850,000, and you have to bite into what the base was. So if you only gave $3 or $4 million, you're biting into your base that you're going to have. You have to go beyond the 5,580,000. This could be a negative for certain people as to what the size of their estates are, but we're going to talk about discounts and things in a few moments. Valuation rules. I want to jump on here. As of right this minute, I could form a family limited partnership. I could gift to my children at 10% interest. It's worth $5 million. It would seem like that's worth $500,000 to them. Excuse me, but I might be able to get marketability and minority discounts that might let me knock the value down 30 or 40%, meaning that maybe the value on this thing is going to be less than $500,000. You can still do that up until the date of the enactment for non-business assets. Non-business assets, what does that mean? It could be real estate property or triple net leases. It could be stocks, bonds, cash. We had one family partnership, we had cash in it, and the discount was like 20%. And you think that's crazy, how can you do it? But family discounts, I'm sorry, family marketability and minority discounts were allowed for all sorts of businesses. And now we thought under the proposals they were talking about with Biden's proposals back with the Treasury Department listing that they were going to do away with all these discounts. I'm surprised, which makes me think there's going to be a round two coming around the corner once round one gets done. Okay, so if you happen to have triple net lease rental properties, you have portfolios, you don't necessarily need it all right now. There's still a chance to get some discounts, but this one applies to transfers after enactment, which means if you want to get a discount on that real estate that's a triple net lease, passive type investments, this is the time to really think doing it. You really have to ask yourself, can you let loose with some of those assets because you don't necessarily get the income off of those assets for right now? And your state may be such that you don't need all the income from that. And this might be an opportunity to go ahead and get your discounts. Remember, you can still do it on business assets. Okay, valuation rules for real estate. Is real estate a trade or business? That's not certain. There's a whole bunch of cases on this prior to this potential law change, but it has been very well held that a triple net lease where basically the tenant paid everything and the landlord paid just their mortgage was not a trade or business. It was a case that had to do with some foreign investors, had to do with foreign taxation, but that's been pretty well established. So again, triple net, you're renting out your real estate, you don't pay anything on it. This could be a candidate for some discounts on gifting before the date of enactment. Okay, valuation rules. This was a good one that came in. Special rules for family farm or business based on current use rather than highest and best use. Typically, if you had a farmland and let's say you could take it and get rid of the farmer and just develop the whole thing into residential lots, the land would be based on the value of all those lots that could be used, I'm sorry, land that could be subdivided and put into lots. But I'm using as a farm. And what they did is they let you reduce the value by $750,000 as long as the family members agree to do certain things for a time. This is one that actually goes the other way. With passage of this, which would be deaths after, in this case, December 31st of 2021, it goes to 11,700. That's quite a gift. Grantor trust. A lot of you have this right now. We need to be thinking about these things. A grantor trust is a trust that's created by the donor. That could be you as an example. And you retain certain things such as income, taxes, you put in extra money for the insurance and so on. And the scheme on this thing, if I use the word scheme, was a lot of times the grantor, you, would set up the trust and say, look, I'll pay the income taxes on this. And that is like making another gift, which is excluded from any of these computations. That could or could not make sense. A lot of times it could be the parent's tax bracket was higher. Sometimes we had losses in the grantor trust. There's a lot of reasons for this. However, the rules on this are changing. And they basically say, well, if you create a grantor trust, the principal of the trust would be included in your estate, except for grandfather trust, ones that are done before the date of enactment, which is down here. Certain trusts are grandfather under the old rule, even grats. I won't get into that, but those are grantor retained annuity trust. We need to take a look at anyone who has a grat. You can grandfather these things, but if you do anything wrong with them, subsequent amounts could be included in state. The one that really comes to mind is the life insurance trust, where you keep on feeding money into the grantor trust to pay the life insurance premiums, and you have it as a grantor trust. And what happens is that some of that life insurance can be pulled back into your estate. Again, need to look at life insurance trust. Just because you have life insurance trust doesn't mean it's going to happen, but it's part of the whole package of, are we involved in the grantor? If you have intentionally defective trust, grantor trust, those are the terms. That's something we should be taking a look at. Watch for life insurance trust. Distributions from a grantor trust during the life of a deemed owner can be gifts. And if you turned off grantor rules, they can be considered a gift. These are the ones that are basically not grandfathered. But there might be some benefits in turning off some of the grantor rules anyhow and making these totally irrevocable trust and they're not defective so that no one messes up on anything. So there's some homework to be done there. Okay, those are the major items for you. I don't want you to think that just because your state's under 5 million, you shouldn't consider this. If you have aspirations to believe your state per person might be over 5 million, there may still be some values in doing some of these things. But for larger estates, over the $5 million per person, you need to contact us for people who work with us, or if anyone listening to this has someone else they work with, they need to do the same thing with their advisors. And with that, Kit, I'm going to turn this back over to you. Thank you.
Great. Thank you, everyone watching today. And thanks, Chuck, for this very informative presentation. If you would like a copy of the slides, email me at info@rcthornton.com. Or if you'd like to set up a call with Chuck, contact us at 602-678-7067. We also invite you to visit our website at www.rcthornton.com and watch our other webinar recordings from our speaker series page. Please let us know if you would like to collaborate on a webinar with Chuck regarding your topic. We would love to work with you. Thanks again and have a great day.